There is a pervasive lie in the trading world that keeps many participants permanently unprofitable. The lie states that somewhere there exists a secret, a flawless strategy, a magical indicator, or a specific combination of settings that will eliminate losses. This belief drives traders into a constant search for the so-called Holy Grail. They adopt a method, experience a few losses, conclude that the method is defective, and immediately move on to another. Charts change, indicators change, gurus change. The equity curve does not. The strategies are rarely the core issue. The lack of sustained, consistent execution is. When a trader continually replaces one approach with another, no meaningful data is gathered. No real understanding of strengths, weaknesses, or variance is developed. The trader remains at the surface level of every method and masters none. Consider a trader named Michael. Michael uses multiple monitors, pays for professional charting software, subscribes to news feeds, and owns numerous trading courses. On Monday, he discovers a video promoting a 95% win rate RSI strategy. The backtest examples appear impressive. He configures his charts to match the demonstration precisely. On Tuesday, he takes 3 trades using this RSI system. 2 are profitable, 1 is not. The day ends in net profit, and he feels encouraged. On Wednesday, the market environment shifts to a choppy sideways condition. The same RSI rules produce 3 consecutive losing trades. The combined result erases Tuesday's gains and places him slightly negative on the week. A professional trader would interpret this sequence as normal statistical variance. No strategy wins in all conditions. The correct response would be to continue executing the plan until sufficient sample size is reached. Michael does not interpret it this way. He interprets it as proof that the RSI strategy does not work. He blames the indicator, the market conditions, and the content creator. On Thursday, he discovers another approach labeled smart money concepts that claims to reveal how institutions trade. The charts now display boxes, zones, and terminology such as order blocks and liquidity grabs. The complexity suggests sophistication and thus credibility. Michael deletes all RSI work and reconfigures his charts again. On Friday, he takes his first trade using the new smart money rules. The trade loses. By the end of the week, he is down 5%. More importantly, he has gained no reliable information. He does not know whether the RSI system has a long-term edge. He does not know whether the new smart money concept has an edge. He has not isolated whether the issue is the strategy, his execution, his risk management, or simply random variance. Michael is a strategy hopper. He believes performance is primarily determined by the tool, not by the user. However, giving a novice the world's most advanced instrument does not produce mastery. A skilled practitioner with basic tools will always outperform the unskilled operator with expensive equipment. The limitation is in the operator, not in the platform. Contrast this with another trader named Sarah. Her approach is deliberately simple and extremely consistent. She maintains a single indicator on her chart, the 200-day moving average. Her entire framework is as follows. If price is above the 200-day moving average, she looks only for long positions. If price is below the 200-day moving average, she looks only for short positions. She waits for price to retrace toward the moving average. She enters with a predefined stop loss on the opposite side of the structure. She risks 1% of capital per trade and targets approximately 2%. There are no oscillators, no elaborate smart money labels, and no complex overlays. She has applied this single method for 4 years. As a result, she understands precisely how it behaves in trending versus ranging markets, in high versus low volatility environments, and across different instruments. On the same Wednesday when Michael is confused and frustrated by a choppy market, Sarah observes the identical conditions. Her 200-day moving average is flat, and price is fluctuating around it without clear directional bias. According to her rules, this is a low-quality environment. Her response is to remain flat. She does not trade. She neither gains nor loses. She simply reserves capital and mental energy for another day. Over the course of a year, Michael deploys 10 to 15 different strategies. He acquires surface knowledge of many techniques but achieves depth in none. Due to frequent resets, his edge never has time to emerge even if it exists in theory. He finishes the year with a substantial drawdown, attributing failure to a rigged market. During that same year, Sarah executes only her simple moving average method. She studies the nuances of entries, exits, and risk placement. She records results and refines execution incrementally. She ends the year with a solid positive return. Compounded over a decade, her consistency produces substantial wealth, while Michael eventually abandons trading entirely. A quote from Bruce Lee encapsulates this dynamic. "I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times." In trading, income is generated from mastery, not variety. Markets reward specialists and penalize generalists. A useful analogy is the contrast between a sniper and a machine gunner. The strategy hopper behaves like a machine gunner, firing rapidly in multiple directions with numerous weapons and techniques. Ammunition is depleted quickly. Noise is high. Accuracy is low. Fatigue is constant. The specialist behaves like a sniper. One rifle, one scope, one firing protocol. Hours or days of observation and waiting for a high probability opportunity. When the trigger is finally pulled, the probability of success is high because the action is taken within a well-studied, controlled framework. The impulse to seek complexity is driven by complexity bias. Humans tend to assume that complex problems require complex solutions. Financial markets are undeniably complex. This visual and informational complexity leads many traders to believe a winning system must also be intricate. Numerous indicators, multiple filters, and elaborate rules. In practice, adding more variables usually degrades performance. This leads to curve fitting, the construction of a strategy that fits historical data perfectly but fails in live conditions. With 10 indicators on a chart, it is always possible to justify an action. Different tools often provide conflicting signals, leading to analysis paralysis or selective attention to signals that confirm pre-existing desires. Simple strategies built on fundamental market behavior, such as trend, momentum, support and resistance, or volatility, tend to be more robust. They are grounded in human psychology, which is relatively stable over long periods. Fear and greed exhibited in markets today are not fundamentally different from those observed a century ago. To break the cycle of strategy hopping and move toward the kind of consistent profitability exemplified by Sarah, it is necessary to commit to structured testing. This can be formalized as the 100 trade test. The framework is as follows. Rule 1. Select a single strategy. The specific type, support and resistance, supply and demand, breakout, or moving average crossover is less important than your ability to understand it and define it clearly. The rules must be objective and repeatable. Rule 2. Execute 100 valid trades using this strategy. Valid means that each trade strictly follows the predefined rules. Take every qualifying setup. Do not take trades that do not qualify. The sample size must reach 100 before any serious evaluation is made. Rule 3. Do not alter the rules during the test. Do not add new indicators after a losing streak. Do not move stop losses away from their defined positions on a discretionary whim. Do not adjust targets arbitrarily. For 100 trades, function as a systematic operator, not as an improviser. Rule 4. Risk a very small fixed fraction of capital per trade during this test. A typical guideline is 0.5% of account equity per trade. This low risk allows for natural losing streaks without catastrophic drawdown. For example, 10 consecutive losses at 2% risk would equate to a 20% drawdown, which is psychologically and mathematically destabilizing. The same sequence at 0.5% risk results in only a 5% drawdown, which is manageable and allows continuation of the test. Most traders abandon a strategy after approximately 10 to 15 trades, usually following a short period of adverse performance. At that point, there is insufficient data to determine whether the strategy lacks edge or whether the outcome is merely variance. The premature exit prevents any genuine conclusion. For those who complete the 100-trade test with consistent rules and sensible risk, an observable shift occurs around the midway point. By approximately trade 50, mechanical uncertainty begins to diminish. Pattern recognition improves. The trader no longer hesitates over basic questions, such as, "Is this a valid setup?" because they have been answered dozens of times already. Subtler aspects emerge. Which market conditions to avoid, which entry triggers are more reliable, and how different times of day or volatility regimes interact with the method. This accumulated experience leads to an important realization. Mastery is not solely about knowing when to act, it is equally about knowing when not to act. Sarah's familiarity with her moving average strategy allows her to disregard marginal signals. She can recognize low-quality conditions that meet the technical criteria but fail in practice due to context. Such intuition cannot be purchased, downloaded, or copied. It must be earned through repeated exposure to the same structure. An analogy can be drawn from professional sports. An elite shooter, such as Stephen Curry, has executed tens of thousands of three-point shots in practice. He does not frequently overhaul his shooting form based on every new video or opinion. The repetition of one refined technique produces automaticity and consistency under pressure. The same principle applies to trading. Once a trader has defined a robust, simple setup, the objective becomes repetition and refinement, not endless replacement. Boredom is a positive signal in this context. If trading feels exciting, it is often a sign that randomness, improvisation, or gambling behavior is present. When the process is defined and internalized, the dominant experience is patience and disciplined waiting. The practical assignment is as follows. Choose a single, simple strategy that is logically understandable. Document its rules clearly. Decide on a fixed, small risk per trade, such as 0.5% of account equity. Commit to a 100-trade test in which every qualifying setup is taken, no non-qualifying trade is entered, and rules are not modified mid-test. Avoid the temptation to seek alternative systems during this period. Avoid adding indicators in response to emotional discomfort. Allow the data to accumulate. At the end of 100 trades, there will be sufficient information to assess whether the strategy has potential and whether execution can be improved. The goal is to transition from being a perpetual beginner like Michael, who restarts at level 1 every week, to becoming a focused specialist like Sarah, who develops depth in one approach and allows consistency and compounding to do their work over time.